Thank you. Good afternoon. I'm Rob Fuhrman. I work with Marin Katusa at Katusa Research. I've been with Marin for a number of years. If you're not familiar with Marin's work, he's one of the most prominent, successful resource financiers over the last 15 years. We run about a $200 million commodities-focused private equity fund, and we also write a retail newsletter as well. So that's called Katusa Resource Opportunities. Feel free to Google us. There's all kinds of great information on the website. And I'll stop my elevator pitch there because I've got lots of good stuff to talk about today. So green energy is a really interesting topic, and sort of the battery metals. And there's some things that Marin and I have been investing in for a number of years. Marin made his first lithium deal over 10 years ago. So long before electric vehicles were all the rage. And green energy we've been investing in for a number of years. We were buying renewable power companies for fractions of what they were paying the last few years. Our biggest win was Altera Power, which was Ross Beatty's company. We bought it for 30 cents after it went from $4 down to 30 cents. We bought it there. And within 4 years, we were bought out for 100% premium, which is pretty good for a utility company. So, first up, the electricity generation stack has changed significantly over the last 40, 50 years, and it's going to continue to change as we move forward. The utility market is going to change significantly, and it's going to become a lot more nimble. And so what you'll see there in black, fossil fuels made up the whale's share of the electricity generation, 75%. Renewables are obviously zero back then, and natural gas around 15%. Last year, the chart on the right, fossil fuels now are under half. Green energy is over 10%, so that's pretty significant. And the reason for that is because hundreds of billions of dollars have gone into the sector. So in the last 10 years, there's been maybe $100 billion spent in gold exploration in total. Well, in green energy, over $300 billion is spent every year for the last decade. And there'll be another $300 billion spent every year for the coming decade. So that's a pretty significant amount of capital moving in. So whether you're a North American citizen who already has electricity and air conditioning, or you're in India, or you're in Brazil or a developing country, and you're pushing yourself to be better, and you want electricity and you want air conditioning, electricity growth is not going to stop. And so the major takeaway here is that energy consumption is going to go up 30–40% between now and 2040. You also have to remember that the utility companies are extremely slow moving. So this is a serious amount of money that has to be invested quickly. So where is it going to go? Well, to make things worse, coal and natural gas plants are going to face retirements significantly over the next 30 years. And you see that in black and red. So red is natural gas plants that are being retired globally, and black is the coal plants that are being retired. And so not only do you have a significant increase in electricity consumption coming, but you've got a significant decrease in actual generating capacity. So you've got this really large expansion that you need to capitalize on. So what's going to happen? Well, this is what the fuel stack is going to look like moving forward into 2040. And you'll see that renewables, which is in green, is going to capture this entire spread. Coal, natural gas. Natural gas will do okay, and especially in North America because it's very cheap. But fossil fuels are dead. Not just here, but in the rest of the world. China's spending some money on coal, but there's far more invested in the renewable space. This is another way to look at it. This is market share. You can see that fossil fuels were 42% last year, and they'll be decreasing to under 25% by 2040. Renewables, on the other hand, are going in the exact opposite direction, and that's where you want to be investing. You want to be investing in that side of the curve where the economy is expanding. You don't want to be investing in something that's diminishing every year, right? So you want to go from 9 or 10% market share to 37%. That's where the growth is, and that's where the investment is. So the key takeaway here is we're at the inflection point. I mentioned earlier that we've been investing in green power for a long time. Green energy used to be trendy, it used to be a fad, and it was a fad and trendy because it didn't actually make economic sense, because it was too expensive. Well, now it's actually more competitive on a regional basis and a global basis than all of your commercial baseload powers. The best way to measure that is through the levelized cost of energy. And so essentially what this is an apples to apples comparison of the different costs, full all-in costs associated with producing a megawatt hour of power. You'll see in yellow solar back in 2009 was over $350 per megawatt hour of power. Compare that to a coal-fired plant, which was in black, with a little over 100. Well, clearly, the solar panel companies and the solar farms were not going to make any money, and that's why they went bankrupt back then. It makes sense. Nobody was going to sell them power. Nobody's going to buy power from them for that price unless the government subsidizes it, which they did in some circumstances, but not all. Move forward into 2018, now things are a lot more competitive, and that's why we're going to see that shift, and it's going to continue into the future. This is another way to look at it. So this shows the 2009 costs versus the 2018 estimates. These are our in-house estimates for 2018. Those 2009 numbers are fully accurate. And so this really shows that dramatic difference. And you'll see that solar and wind are the cheapest forms on an all-in basis than any of the baseload power operations. The interesting takeaway here is that I actually used US natural gas prices for the all-in cost for natural gas, gas combined cycle. And the interesting thing here is that in the US, they're swimming in natural gas, as they are in Canada. As we have the lowest costs for natural gas anywhere in the world. So in China, that same natural gas price is probably $8. And so that actual cost per megawatt hour is actually about $80. So that makes solar and wind that much more competitive than even its closest competitor like natural gas or coal. It's something to really consider moving forward. So what has driven all this innovation? Well, for wind turbines, actually pretty straightforward, and I just stole this the other day actually because I thought it was pretty representative. The bigger the wind turbine you got, obviously you're going to generate more power. There's been some differences in terms of big data and how they collect and analyze where to put the wind farm, but at the end of the day, bigger is better. And so you've had wind farms that used to be the size of the Statue of Liberty, while now you're putting these wind farms offshore, and they're going to be two or three times that size moving forward. And so you produce far more electricity per turbine. Solar is really interesting. Essentially what you've got here is you've got a graph that shows the energy efficiency of a panel. Essentially in the bottom left you have the energy efficiency is 14%, so that's how much energy you could harness per panel in 1960. The next data point that you can kind of see, which is about in the middle, is First Solar, and that's in 2015, and that efficiency is 18%. Within 2 or 3 years, the chart's now at the top of the graph, and they're making panels that can harness 46% efficiency in a lab. So that's 3 times more energy that you're able to capture on a per panel basis. It's enormous. It's like having a gold mine where you used to produce 100,000 ounces, and now you produce 300,000, and nothing's changed. And your costs have gone down. So it's a big deal. So the other place that we've seen significant changes is in the battery metal sector. And as I mentioned, Marin and I have been involved in the sector for a long time, been on lots of site trips down to Argentina, might be going to the Congo to look for DRC, cobalt, all that stuff. We're highly, highly invested in the sector. And battery basics, just like in green energy, there's an extremely steep learning curve. And we're just starting to get to the point where we're at that inflection point again where electric vehicles are going to become the norm because they're competitive. Nobody's going to buy an $80,000 electric vehicle right now if you can buy, or a regular consumer will not, if you can buy the same car for $28,000 and it's gas powered. You'll only do it if it's trendy. You'll only do it if you have the means. However, moving forward, as you're going to see here in this chart, and I'll explain to you, the cost of these electric vehicles are going to come down substantially. And where all of that cost coming down is essentially going to be in the cost of the battery. And so there's going to be a few cobalt companies and lithium companies that are probably not going to like the next few slides, but happy to talk to you after. So this is the forecast for the battery pack cost on a per kilowatt hour basis. And you can see this is very similar to what happened in solar, where you've got this chart that starts at the top left and is going to end at the bottom right. And in between is a huge learning curve where there's a ton of money that has to be spent. And like I said, in 2010, $1,000 a kilowatt hour, your battery is going to be $20,000, $30,000, $40,000, depending on the size. Nobody's going to buy that car. That's why Tesla's still not selling too many, right? You move forward 10 years, okay, now you have a real battery. And so below the cutoff to break even is about $100 to $150 on a kilowatt hour basis. That's sort of the rough number that people are guessing. And if you look on the chart there, that'll be about 2025 or so, give or take a year or two. I actually think it'll probably be faster than that, just the amount of money that's going into the sector. So really quickly, this is battery chemistry 101. there's a whole bunch of bars here. Essentially, you can actually disregard almost all of them. In the last 2 years since I've built this little model, almost all of these chemistries are already obsolete, okay? LCO was the original lithium cobalt battery. It's a great battery, except there's no cobalt in the world, so that one's out. NCA, that's the battery type that Tesla uses, okay? So that's an important one. That's a good chemistry. That's a lithium ion, nickel, cobalt, aluminum battery. That's a key battery type moving forward for sure. LMO, not going to happen. LFP used to be the Chinese battery, but it's had 0 range. You could only drive about from here to the end of the block, and then it would die. So that one's out. NMC is a nickel, manganese, cobalt battery. That's also a lithium ion battery. And the numbers underneath there are what's important, because that's the actual trend, and that's what's happening in the battery sector that you guys need to pay attention to. So that 333 represents the ratio of nickel, manganese, and cobalt within that battery, within the cathode. And so obviously a higher amount of cobalt, we all like cobalt, higher ratio means more cobalt demand moving forward, right? Well, the problem is the industry is moving away from that rapidly because there's no cobalt. There's very little supply, and that's okay if you can find enough, but we're getting to this pinch point where there just isn't enough, and so companies actually have to substitute away because there isn't enough. And so what we just saw, if anybody was listening to Elon Musk on the Tesla conference call the other day as he berated analysts, the one important thing he did say was that they've almost entirely phased out cobalt from the battery. That's huge, okay? Because if they can do it, so can everybody else. I used to be the biggest cobalt bull in the entire room. We were looking at financing cobalt companies when it was $10 a pound, and companies were trading for 10 cents that are now going for $2 or $3. Industries change. It changes really rapidly, so you have to be very careful with who you're talking to about battery chemistry. For those who haven't seen this before, this is the EV sales forecast. Nothing super surprising here. This is our model. Essentially what you've got is you've got 450,000 cars were sold in 2015, and then there's 60 million sold by 2040. So that's an enormous difference. Okay. Well, I want to capitalize on this. I want to be involved in the sector. And so Mary and I thought about it and said, okay, well, how are we going to do it? Well, are we going to invest in a company like Tesla? Are we going to invest in Volvo? Or that's sort of just betting on one jockey. And so we said, okay, well, no. The best way to do it is to play the battery chemistry, because every car needs a battery. So you're sort of like selling bullets and guns to both sides in the war. You've all heard that analogy. This is the same concept. So a little bit back to basics here for those who aren't aware. Lithium is the cornerstone of the battery sector for sure, has been for a while, and until the battery chemistry really changes in terms of they actually move away from a lithium ion battery into something else, lithium is going to be a key player. Lithium is actually controlled by 4 companies essentially. 4 major companies control 80% of the world's supply, and they're going to continue to do that. So the way that we're thinking about this is we're looking for development stage projects. We're not really going into the high-risk juniors because we don't see enough value add there at this point. Roughly there's about 90 pounds per EV, depends obviously on what EV battery pack you use, how big the kilowatt hours are and stuff like that, but that's sort of a rough metric for you to use at home. This is probably a chart that not too many people are going to show you. So this is lithium economic supply and demand. So this is pretty important, and you'll see there at the bottom, yeah, this looks okay on there. So the bottom part is about 200,000 tons of lithium, and then all those bars represent expansion potential. So those are new mines that are already in operation, and then any mine I've included here that's about at the PEA or pre-feasibility stage. And so that's stuff that can be brought on within the next 3 to 5 years, maybe 7. And so that's a fairly aggressive forecast. And basically what it shows here is that supply is going to outstrip demand significantly from now until about 2025 or so. Well, when you have supply outstrip demand by that much, the price is going to go down. And so that's going to make life difficult for some of the juniors, and it's going to make life difficult for a lot of the hard rock lithium producers, which is why we focus strategically and only on lithium brine companies, and I'll explain that towards the end. Cobalt, is the party over? Well, if Elon Musk is phasing it out, I think a lot of other companies are going to follow suit. I realize it's an integral part of the battery, but there's not enough of it in the world. I don't care who you are, there's just not enough. And people are going to migrate towards a more nickel-intensive battery. So this is a similar chart. This is supply and demand for cobalt. The big theme here was that the DRC produces a significant quantity of cobalt. And okay, well, fine, so we'll go somewhere else and find it. Well, there isn't very much. Most of it's found in a copper nickel deposit, and most of those deposits that are being promoted now as cobalt deposits are failed copper projects or nickel projects. Not a good sign. So I've got a bullish and a bearish call for cobalt there. The big gray bar is actually an interesting one. That's the big DRC mine called Komodo. It's run by Glencore. That one may be coming back into production within the next year or two, depending if they can actually get the processing facility done. That would alleviate some costs there. But I went from extremely bullish to very cautious in the span of about a year based on these migrations in battery technology. So what's our thesis then? Well, our thesis is actually copper, because copper is used in green energy and it's used in the EV. It's used significantly in both. Wind turbines use 4,000 pounds of it per megawatt, and a wind farm is 200 to 400 megawatts, so that's pretty significant demand. EVs use 100 to 150, and the more electrified the grid and the world becomes, you need more copper. There's also way less discoveries now. There's not nearly as many major copper mines being discovered in the last few years. The copper market's big, so there's lots of demand potential here. So what I did is I really quickly graphed the copper demand from EVs and renewables. So that's about 6 million tons by 2040. It doesn't sound like a lot. So the copper market's about 25 million metric tons right now. So you're looking at about 20%, 25% of production by then. So that doesn't sound like a lot, except the world's largest mine is Escondida, and it produces 1 million tons per year. So by then, we need 5 more Escondidas. That's a significant amount of copper. I can't tell you when the last Escondida was found, other than Escondida itself. So to sort of sum up, where to be in the battery space, copper thesis for us, very important, world-class assets. We're looking at development stage assets here, potentially a little bit lower into the resource sector, or in the resource, first original resource, but mainly world-class, large-scale, safe jurisdiction copper plays. Lithium, got to be development stage, no juniors, not at this point. Remember when I talked about that supply curve? There's going to be price depression. That's going to make it hard as a lithium junior to finance, to explore. And make sure it's a salar. A salar is like a lake. It's either above ground or underground. They're found mainly in the lithium triangle, which is in South America, Chile, Peru, Bolivia, Argentina. And development stage there, brine only. Brine is the lowest cost of production in the world, so you want to be focused there. As prices come down, you want to be in low-cost production. And cobalt, I still love it, but I want feasibility stage or later because I want to be able to capitalize on the prices. Cobalt's ran from $10 a ton to $40 a ton in a few years. It's probably going to stay up there, but unless you have a project that's at feasibility that can actually start selling pounds of cobalt, you're not going to realize any value there. You're not going to get any revenue. And so that's why we're looking at feasibility or later stage projects. And there's only a very small handful of those. And I think all those will get financed and will be put into production. But the early stage stuff, it's a little bit more difficult now than it was a few years ago.